Hey everyone. So today, we're diving deep into the stock market, and we're going to look at it from two totally different angles. First, there's the version you read about in textbooks, and then there's how the game is actually played. We're going to break down that difference between the clean theory and the, let's say, messy reality. Let's get right into it.
So what is the real difference here? Well, the official story, it paints this picture of a fair, level marketplace where the best companies just naturally rise to the top. But the reality? It can feel a lot more like a high-stakes game where the most sophisticated players have a massive, massive edge. So let's break down what that really means.
Okay, first things first. Let's cover the textbook rules. This is the stuff you'd find in an Investing 101 course. The absolute foundational concepts of how the market is supposed to work. And it all starts with this one simple idea, the share. Now, when you buy a share of a company, you're not just buying a ticker symbol on a screen. No, you're buying a tiny, fractional piece of the actual business. You literally become a part owner of that company. So why would you even want to own that tiny piece? Well, it really boils down to two main reasons. The first is what we call capital gains. That's the hope that the company does well, its value grows, and you can sell your share for way more than you paid for it. The second is dividends. That's when a company is so profitable that it decides to share some of those earnings directly with you, the owner.
So what actually makes a stock's price go up or down? The textbook answer is, honestly, beautifully simple. It's all about supply and demand. If more people want to buy a stock than want to sell it, the price has to go up. And if more people are trying to sell, well, the price falls. Easy enough, right?
And what drives that supply and demand? Well, in a perfect world, it's these four rational things. How well is the company actually doing? What's the overall health of the economy? What are the big trends in that specific industry? And finally, what's the general mood of investors? See? It all sounds very logical, very straightforward.
And that brings us to the million-dollar question, doesn't it? If everything is based on these clear, logical factors, why does the market so often feel chaotic, unpredictable, and sometimes just plain unfair? This is where we flip the coin and look at the other side of the story.
Because here's the reality. Not all investors are created equal, not by a long shot. We're not all working with the same info, the same amount of money, or the same influence. You've got these institutional players. We're talking massive hedge funds, huge investment banks, and they have advantages that most of us just can't even touch. And this really gets to the heart of this short-term game. On any given day, the market is basically a zero-sum battle. For a giant fund to get a fantastic bargain on a stock, they need someone else on the other side of that trade selling it to them at that rock-bottom price. And who is that someone? Well, too often, it's a smaller investor. Someone selling out of fear or just plain confusion. So, how do they do it? How do they get that edge? Let's get into the nitty-gritty. We're going to look at a couple of common strategies that the big, sophisticated players use to tilt the playing field in their favor. Here's a classic for you, short and distort. It's a three-step process. First, a fund places a huge bet that a stock's price is going to go down. Then, step two, they launch this coordinated campaign to spread negative rumors and sow what traders call FUD. That's fear, uncertainty, and doubt. As smaller investors start to panic and sell off their shares, the price drops, and step three, the fund cashes in, profiting from the very decline they helped create. And get this, even the safety nets you put in place to protect yourself can be used against you. A lot of investors use something called a stop-loss order. It automatically sells your stock if it drops to a certain price. Well, large traders can often see where big clusters of these stop losses are, and they can intentionally push the price down just long enough to trigger that cascade of automatic selling. It lets them scoop up all those shares at a discount. So what's the big takeaway from all this? This isn't just about charts and numbers and algorithms. At its very core, this is psychological warfare. It's all about weaponizing the two most powerful human emotions in the entire market, fear and greed. And this really sums it all up perfectly. When these large institutions want to load up on shares of a really good company, they work to create fear and panic so that you'll sell to them cheap. And then, later, when they're ready to unload those exact same shares and take their profits, they create hype and excitement to attract buyers at a much higher price. And all this leads to something a lot of investors have probably felt before, the shakeout. It's when a great stock has good news, it starts to tick up, and then bam! Out of nowhere, there's this sharp, scary price drop.
A lot of times this is specifically designed to shake out what they call the weak hands, to scare nervous investors into selling their shares right before the real sustained move up actually begins. Just think about it for a second. Have you ever sold a stock just totally frustrated after a sudden, nasty drop, only to stand by and watch it rally like crazy right after you got out? If that sounds familiar, you may have been on the receiving end of a shakeout. It's an incredibly common and frustrating experience.
Okay, so if the game is being played with all these hidden rules, how on earth can you protect yourself? Well, the good news is you're not helpless. Just knowing this stuff is the first huge step. The next step is having your own solid protection playbook. Here are 4 really powerful strategies to keep in your back pocket. Number 1, think long-term. You've got to act like a business owner, not a gambler. These short-term games matter a whole lot less when your time horizon is 5 or 10 years out. 2, question sudden narratives. When you see some dramatic news stories spreading like wildfire, always ask yourself, who benefits if I believe this? 3, use limit orders. This lets you set the exact price you're willing to buy or sell at, and it can protect you from making emotional, panic-driven decisions. And finally, maybe the most important rule of all, know why you invested. Do your homework, have real conviction, so you can't be easily shaken out of a good position.
So look, the stock market isn't always that simple, level playing field we read about in books. It's a really complex arena with different rules for different players. But by understanding both the textbook and the reality, you can navigate it so much more wisely. You can avoid the most common traps and really focus on what truly builds wealth, long-term value. The question isn't whether the game has its flaws, it's whether you have the knowledge to play it well anyway.